Welcome to Insights 2 Incomes. In this video, I'll share 9 common financial pitfalls and strategies to overcome them. Before we get into them, don't forget to subscribe, like and share. Let's dive right in. Tax efficiency. Understand and utilize tax-efficient investment vehicles. For example, investing through an individual savings account or a Roth IRA can shelter your dividends and capital gains from taxes. Learning about these options and incorporating them into your financial planning can significantly enhance your long-term wealth accumulation. Emergency fund building. Aim to save at least 6 months' worth of living expenses. For example, if your monthly expenses are $2,000, strive to save $12,000. This fund acts as a financial buffer against unexpected events like job loss or medical emergencies, ensuring you're not forced into high-interest debt. Overcoming investment procrastination. It's easy to find reasons to delay investing. However, the sooner you start, the better. For example, if you start investing $100 a month at age 25, you could have over $150,000 by age 65, assuming a 7% annual return. Waiting until 35 to start would cut this amount in half, assuming the same monthly contribution and return rate. Awareness of income and expenses. Avoid lifestyle inflation by regularly monitoring your income and expenses. For example, a promotion might increase your monthly income from $4,000 to $5,000. Instead of upgrading your lifestyle to match this income hike, maintain your previous spending levels and allocate the extra $1,000 towards savings or investments. Paying yourself first. This concept, popularized by Rich Dad Poor Dad, is about prioritizing savings over expenses. Instead of paying bills and then saving what's left, reverse the order. For example, if your monthly income is $3,000, immediately transfer $300 10% into a savings or investment account. Treat this like a mandatory expense, just like rent or utilities. This ensures you're consistently building your savings, regardless of other expenses. Managing expensive hobbies. Balance costly hobbies with financial goals. For instance, if you enjoy golf, which can be expensive, set a monthly budget for it. Find ways to enjoy your hobby cost-effectively, like playing at less expensive courses or buying used equipment. Timely investing. Start investing as soon as you have an emergency fund. Even small, regular investments can grow substantially over time due to compound interest. For instance, investing $200 a month at a 7% annual return will grow to over $31,000 in 10 years. Avoiding bad debt. Avoid using debt for non-essential purchases. For instance, instead of buying a $1,000 TV on credit with a 22% interest rate, save up and pay in cash. This habit prevents unnecessary interest payments and encourages disciplined spending. Remember, credit card companies profit from high interest rates and penalties, which can quickly escalate the actual cost of purchases. By understanding and implementing these financial habits and strategies, you can build a stronger financial foundation, reduce unnecessary expenses, and enhance your ability to grow your wealth over time. Remember, financial planning is not just about cutting costs. It's about making smart choices with your income and investments to achieve your long-term goals. In conclusion, financial freedom and wealth building require a holistic approach, balancing savings, understanding expenses, and strategic investing. Want to delve deeper into these topics? Let me know in the comments if you're interested in a focused video on tax strategies or investing during a recession. And don't forget to check out my other videos on building wealth and making your money work for you. Don't forget to subscribe, like and share.